10:32, I think, and I'll call the pension committee meeting to order. Special counsel, please call the roll.
Director Pacho,
Here.
Director Schollers,
Here.
Director Antrim,
Here.
Director Markowitz, Ms. Shine, Mr. Davis, Ms. Jonesy,
Here.
and Mr. McBool is here. He stepped
Yeah.
out for a moment.
Yeah.
So you do have a quorum.
Okay. Let's proceed. We have a presentation, or some presentation items from Quaco and Moquett and Associates. So at this point in time, let's proceed with those presentation items.
Okay, great.
Quaco?
Thank you. Good morning, everyone.
Good morning.
So the goal is to go through November performance. So we have performance for the month of November, and then we'll go through an update on the asset allocation. I think that will dovetail nicely into the discussion we've been having
Good.
on private equity.
Right.
So the month of November, we can see here, was a really good month for the markets. The stock market, the S&P 500, was up 9.1% for the month. The international markets, you can take the ACWI or the ACWI ex-US or the EFI index, both of these between 9 and 9.3%. Across the major indices, we were looking at really good performance. So quick recap on the markets. September, we saw a sell-off. October, we saw a sell-off. November, we saw a really sharp rebound. Even fixed income had a pretty decent month. So year-to-date, fixed income is back in the positive. And as we look at this story, the story continues to tell us that 2023 year-to-date has been a really positive year for the markets. But year-to-date, we do see a lot of volatility. So if we look at the exhibit on the right-hand side and we compare it to the exhibit on the left-hand side, we get a sense of how the different styles have performed differently in this environment. So by the different styles, I mean value, core, and growth right in the middle of the page. You have your value stocks. You can think of your Procter & Gamble's. These are your older, more mature types of companies, your Unilevers and so on. And then your growth stocks. These are your Teslas, your Apples, Facebooks, Googles, and so on. And really in this environment, growth has dominated, value has lagged. So that's the real big takeaway from this particular page. But we'll see momentarily that the performance for the portfolio was really strong. So we were up 7.3% for the month of November. We see here doing better than the benchmark. Year to date, a really nice result of 10% year to date. And as we look at the various composites, REITs added value to the plan. Fixed income was essentially flat. And then equities did detract a little bit from a performance standpoint. And when we look at performance, again, pretty nice results coming in. So the top line is the performance of the portfolio. Bottom line is the performance of the benchmark. And we do see that we've outperformed the benchmark across many different periods measured. Where there is underperformance, I'll give you an example. The 1 year period, that's a 30 basis point differential. So hardly a big swing when we think about the differences in performance when we've underperformed. The various composites have held up relatively well. Fixed income performing in line with the index. As noted earlier, equities year to date are above the index, but they did detract slightly in the month of November. The alternatives composite, again, that's in liquidation. So we have a manager called Prisma in this allocation. Prisma had around 18 to 20 million total when we first came on board. That allocation is about 1.8 million now. So not a meaningful allocation in the portfolio, but nonetheless, you'll see that their performance did detract a little bit versus the benchmark. REITs held up well, as did the infrastructure composite. And then from a performance standpoint, we do see here that the Pyramis strategy from a fixed income standpoint was a positive contributor. Ernest Partners on the non-US equity side of things, also a positive contributor. While the REIT fund did lag the index by 10 basis points, we are looking at strong absolute performance as well over that year-to-date period. The asset allocation, we see here we have some overweights and underweights. Per the policy, the biggest underweight we have presently is private equity. There's our 10% allocation to private equity. You can see here the target allocation based off dollars as of the end of November was 22.2 million. That's basically how we read that exhibit. And then that would represent 10% of the portfolio assets. So the discussion we're having around private equity is in line with what we're looking to accomplish with the approved asset allocation. This is just a running tally of the actions that we've taken. So coming on board and changing an asset allocation, there can be a lot of moving pieces. And the goal here is just to highlight what those moving pieces have been over different months. You'll get a sense of which managers were hired, which managers were terminated, and ultimately just, again, gives you a roadmap of all the actions taken thus far in the portfolio. With the asset allocation, again, we see here the approved allocation on the right-hand side is the one that incorporates private equity. So this would be a first-time allocation for the portfolio. The other allocations that we would be looking to make at a later date would be global infrastructure, private real estate. These would be other areas we'd look to add to. There would also be RFPs for traditional asset classes. Think of your fixed income, think of your equities. So that's all also coming down the line when we think about the portfolio and the managers in the portfolio.
Sorry, quick question. On the global infrastructure 7% does that involve any kind of private equity in that bucket or no?
No, so that would be separate. That would be a separate bucket. We would classify this as real assets. So when we think about real assets, that's real estate and infrastructure. And the type of infrastructure we're investing in would be open-end. So it would be different from the private equity investment. It would actually be a diversifier to private equity if we look at it that way.
Okay.
Yep. With respect to changes that have been made, again, we just go through the transaction dates and the dollar flows. So nothing to really talk about on this page. It's really just there for your record and your roadmap of actions taken.
So can you go back? Why is Vanguard -10?
Because if you remember, we had Vanguard in a REIT portfolio. We eliminated them and put Fidelity in because they were cheaper. So the -10 basically points to we liquidated Vanguard,
Okay.
and then we put the money inside Fidelity. Yep. And that's basically how we read it. Any manager that's been terminated. New South was terminated, 7 million. And then you'll see that all the numbers between green and red, they net out. They add up or cancel each other out.
So go back to the -7. Next one. Go back. Yeah, right there. So where it went.
Yeah, so we have New South, that's Smith Value. You'll see that we had 3 million go into the mid-cap index, 3 million go into the small-cap index, and then the rest was just essentially rounded between the other asset classes. So that's when we ended up taking some of the actively managed strategies that we didn't have conviction in, and then we put those in index funds. So that way, rather than worry about active managers that we don't have conviction in, let's index for now.
Conviction mean we are not locked in, right?
No, we're definitely not locked in.
Okay.
No. So these are index funds. These are the most liquid options available.
Okay.
And it just gives us a lot of flexibility. So when we find the managers that we do have more conviction in, we'd look to transition part of the portfolio to those active managers away from passive. So as we think about current and future active searches, again, this just gives us a sense of where we are. We are currently discussing private equity today. We have global infrastructure and real estate. We've issued the RFPs. We've already received candidate responses. So we can circulate our research team's recommendations around that at an appropriate time and with the guidance of legal counsel as to what constitutes a non-search and informational distribution of materials. As you can see here, non-US small cap emerging markets, US mid cap, small cap, and fixed income are all areas that we are looking to, incorporate some active management in. So that gives us a sense of what's on the horizon for 2024. And this discussion we're having for private equity should really, I think, build a good foundation for conversations going forward. Okay, so with that, should I jump straight to, so I've gone through the performance report. The takeaway is the performance was really strong for the month of November. Nothing else to really report from this end with respect to that. Now, one thing you will see is a slight change in format of the report. So, every decade or so, the data providers we use will, either merge or change the templates, and this is just an example of, I guess, both. We ended up incorporating a company called Paris. So we use InvestorForce for our performance. That has been acquired by another firm. This is the platform that we're using for reporting going forward. It's exactly the same as what you've seen in the past. It's just the color coding is a little different, and some of the exhibits are going to be shown a different way. So that's just an FYI. If there were any questions around the color scheme or the performance report, which I don't think there were.
Let me ask you one question. As far as market volatility,
Yeah.
how can we shield our fund from that up and down?
Yeah. Let me do this real quick. I think this page, I think, does a really good job of talking about the asset allocation and then thinking about market volatility. So, first and foremost, we have a target rate of return that we need to hit. And as a rule of thumb, I would say any target rate of return that's over 6%, let's say, you're going to have to take some risk in the market. The closer you get towards 7 and over 7, the more risk you have to take. So you'll see from our asset allocation, we have a healthy allocation to fixed income. That's about a quarter of the portfolio. The bulk of the portfolio is in equities. But one of the things we're doing in the private equity search, in looking at real assets, is to take some of the equity market volatility off the table. So when we think about the equity market, in any given day, it can go up tremendously, it can go down tremendously in any given day. As a long-term investor, that's okay, right? We have a long-term goal, so the volatility, while it's nauseating, it's something that we can stomach. With that being said, when there are extreme pullbacks in the market, we typically see that the plans that do better are the ones that aren't solely allocated to equities or fixed income. So when we think about the private equity market, that's highly inefficient. So that means that, a very select group of individuals in a position to make money pretty consistently through deal flow and through their underwriting expertise. When we think about real estate, that's an area of the market that's also less correlated to stocks and bonds. And then when we think about infrastructure, that's also a subset of real assets. So those areas will help us bring down some of the overall volatility as we think about the stock market going forward. And then fixed income, it's beginning to perform how fixed income typically performs. So over the last 2 years, we've seen fixed income just go through like humongous highs and ridiculous lows. And that's really been around the Fed's interest rate policy. As interest rate policy appears to be settling, it does appear that fixed income now has a coupon. The volatility that we associate with rates going up and down shouldn't be as extreme going forward. So all of that kind of backs into the asset allocation and then the building blocks that we are looking at for defensive exposure, as well as getting us some returns.
Thank you.
Yep.
And so our anticipated rate of return designed for this program is what value?
7.
Yeah, 7%. So when I said the point of saying 6% is we're at 7. So anything over 6%, like just starting with a blank sheet of paper, we would assume anything over 6% needs to take a certain amount of risk in the market. The closer you get to 7 and the more you get over 7, you can think about turning up the risk to get that target rate of return. So that's really the analogy there.
And that matches our 20-year close amortization schedule based on our population. that's why the goal is 7?
It's in the investment policy statement to have a long-term rate of return of 7%.
And that is set by the actuary, and ultimately the actuary, through their analysis, looking at mortality and then looking at the time horizon of the plan, they would essentially say, look, 7% is the number we need to hit to get to this certain funded status over, X period of time. So the manager lineup is here. Don't really need to go through it because we just went through the composites and we just went through the changes. So if the performance review is concluded, I can just high level go through some talking points around private equity. I did receive some feedback following the last meeting just regarding, breaking down some of the language, fees in private equity, what carry is, what a hurdle rate is, and things like that.
Okay.
Yep.
Okay. I just want to recap so we can move to the action item on the agenda.
And Mr. Chair, while you're doing that, we just would like the record to reflect that Ms. Shine did arrive and is present for the meeting.
Okay. Let me just quickly recap, and then Kwaku, you can help facilitate the process for us.
Yeah,
With
absolutely.
regard to private equity.
Absolutely.
We met November 20th of this year, and we met with the 5 managers, top 5 Tier 1 managers, Adams Street, Sango, Mezzaro, Exponents, and Vista. And the presentations and discussions were facilitated, of course, by Moquette. At the conclusion of the presentation, it was recommended that we meet again in December, and the 13th was selected. So we're at a point now where we've heard the presentations. We did ask a number of questions. I think at this point, Kwaku, to help facilitate the discussion and help us hopefully come to some consensus on 1 or 2 private equity managers. And I think you're going to help us to go through that process.
Yeah,
So with that in mind,
Yep.
if you would proceed.
Yeah, no problem. So jumping into the discussion really quickly, just to, again, just highlight that this is a different asset class compared to your traditionals, right? So your equities, your fixed income. On the fixed income side, you can assume you're paying, let's say, 18 to 20 basis points for your fixed income manager, your active manager. In this asset class, the fees are significantly higher, but the expected returns are significantly high.
What are the expected returns?
So the expected returns are in the double digits. You can think about, let's say,
12%.
12, 13% in terms of IRR as a baseline. So it's pretty high. And then, as mentioned earlier, when we think about the volatility of the market, the lumpiness of the market, these are valued on a significant quarter lag. So it's typically about 2 or 3 quarters after the quarter where you get the final numbers, which really means that as the market goes up and down, you're not capturing all that noise. You're actually just capturing either a write up or a write down. The way things are structured presently, it's been easier for managers to make money. So we've seen more in the way of markups. But as we get into a more challenged environment, the skill of the manager is going to be a lot more important. So you want managers that can do well across different market cycles, different market environments. And that really lends itself to the importance of the team, their expertise, and so on. And when we think about the
One question, the management fees of 2% is based on the initial capital allotment or
Yes.
the final results?
So it's on the, long story short, the managers we're allocating to, they would do it on the final amount. So,
So let's say if you put 10 million and they get as a return of 12%,
right.
they will have 10%, 10 million plus 12% at 2%.
So this is basically how it works, and I'm glad you asked the question. So 2% is the flat fee. So
Okay.
2% is what's going to be charged regardless of
That's all the
performance.
outcome.
Yes. Now, what you have is there's also what they call carry, and it's typically 20%. So there's the management fee, there's carry, and then there's a hurdle rate. So what do these three things mean? So the 2% management fee, you pay 2% irrespective. The 20% carry over an 8% hurdle basically means that up until 8%, the plan gets 100% of all the profits. After 8%, let's say 9%, for every additional dollar that the manager generates, the manager keeps 20 cents of that, and we keep 80 cents of that. And that incentive structure allows the manager, because the manager lives and dies by their performance, and it's kind of a backward thing to look at, but in a lot of instances, the higher your carry, the higher you're paying in carry, the stronger your manager's performance is. So actually, high carry is actually a good thing if we think about it in private equity.
Is that a fixed or negotiable?
No, it's fixed. That's very industry standard.
Okay.
Yeah, so standard industry terms. Some managers will be with some of the funds that we've discussed and met with, they have what are known as co-investment vehicles, which you can essentially invest side by side with the main fund. The co-invest is a way to bring down the fees, so we can still get the fees down a little bit when all is said and done, depending on which managers we go for, but the 2 and 20 is standard.
As far as those last month presentation, is any one of them are outperformed the rest of them?
So let's do this. From a performance standpoint,
That was all in our packet from
Yeah.
last time.
Yeah.
So they went through their performance and they were in each
So
of
I
those
was
packets.
just going to ask him in a nutshell, in a snapshot, who among those presenter was the outclass?
Yeah, so this is where I guess this is the other thing to highlight here. So when we're comparing equity managers, it's very apples to apples, right? So an equity manager, you're looking at the S&P 500, and you can look at a performance of manager A, manager B, manager C, right? In private equity, what we have are vintage years. So what we do is look at the vintage year performance, and in any given vintage year, one manager may perform really well, another may not perform so well. And what we typically look for is consistency across vintage year performance, particularly with more established funds. And what you're looking at here are vintage year returns that are comfortably over 1 times, right? 1 times would mean you invest your money, you get it all back. Anything beyond that is basically money or extra to the fund or to the investor. So what we see here are all of the managers we're profiling. They all have, all of the managers we profiled, they all have really strong returns. So these are good performers. When we think about the universe of managers that responded, we definitely had good responses to the RFP. So an RFP was issued in April, and then our research team evaluated all the proposals, and they put forward the candidates that they, in their opinion, thought would be the best, given the size of the allocation, given the expertise of the team, given the client service and other things that were expected. So all of the RFP responses are at the bottom, and you're going to see a lot of really, really good names there. So at the end of the day, all of the names that were brought forward to discuss their strategies with you in November, these are all really good funds, and the performance is strong across all the funds. And again, the overview of performance is provided in these tables here. So we heard from all these firms. We heard from Adams Street, Sango, Mesirow, Exponents, and Vista. Of all the firms, one firm did not have a track record, which was Exponents. They have a track record of building manager programs. They've done an exceptional job in terms of building diverse manager platforms, but this was the one manager that did not have a performance track record. All of the other managers, again, you're looking at really good multiples, and you're really looking at really strong IRRs, which is the internal rate of return of the portfolio. So as we go through, let me just make sure I answered the question before I dovetail into another part of the presentation. Did that take care of the question?
I was just asking you, among the 5, who was the outperformer?
Yeah, so again, it's tough to say, if we look at all these funds, if we look at all these funds,
The good part.
the so Adam Street, right? So we'll take Adam Street, we'll take their 2018 fund, right? Sango didn't have a fund in 2018, and then Mesero also didn't have a fund in 2018. So it ends up becoming, it's not like looking at two S&P 500 managers, right? You can't just say, well, this manager outperformed and it did the best out of all of them, because they're all doing different things. So when you look at again, going back to the multiples and the IRRs, when you look at the IRRs and the multiples, if those are in the teens and double digits, and the IRRs, the multiples are comfortably over 1%, that's an indicator of really strong performance. Now, Vista saw really, really strong performance in their last couple of funds because it's tech focused. It's large tech focused. That's Robert Smith's fund, and that's what they do. Technology, as we've discussed, has really dominated. In the case of Mesero, that's more small to middle market buyout focused. So they're playing in a different pond, still looking at really, really stellar returns, but it's not an apples to apples comparison because they all have a different niche that they focus on. So all of the managers are good. All of the managers have seen strong returns. Definitely your technology fund would have seen the most strong return. Sango being the newer manager in the pack, what we typically see is with newer funds, the first couple of funds will have good IRRs for skillful managers, but as they get access to more and more deals, you expect the IRRs and the multiples to continually increase. So that's, I think, the healthiest way to read all of those numbers, as opposed to picking, because it's that they don't all do the same thing, and that was the benefit of interviewing all the managers. They're all good, but they all do something different, and ultimately, what's the best fit for the portfolio? I would say from a performance standpoint, we're expecting all of the managers' profile to do a good job for us, and that's why they're in front of us. And with respect to how the managers invest, what their targets are, it is summed up on these particular exhibits. So the geographic allocations are going to be a little different between the managers, Sango in particular. When we think about the breakdown between the different types of private equity investments out there, Mesero is going to be very different from Vista. So again, this document does a really good job, in my opinion, of just fleshing out what each manager is trying to do. And then ultimately, for us, the decision is, okay, who's going to be the best fit for us? So as we think about best fit, there were some follow-up questions for the managers, and we incorporated this in a table. And the questions were around manager diversity. I do want to say this, and I definitely want to say this as a fiduciary. Manager diversity, in my opinion, it's an important statistic to look at. It's a critical statistic to look at, but none of these managers are being profiled because of, it's the right thing to do, right? These are all good investors. These are all solid teams. These are all high caliber individuals, and the diversity of the team is a significant plus, right? When we think about, we want good people managing money for us. Yes. Are they diverse? Yes. That's really, how we look at it as investment professionals. And as we think about the various firms, you'll see Adam Street, for example. This is the breakdown of their diversity as a firm. We see across the different categories, the different segments, what the diversity of the team looks like. Mesero, we also take a look there, and we get a breakdown of the diversity of that team. Sango, not surprisingly, is the most diverse firm, just given where they're located and their focus. And then Vista, also another diverse firm, once you slice and dice it across the various categories. So these are the diversity statistics provided to us. When we go into other bits of information really quickly.
Could you go back, back to
Sure.
that one?
Yes. So on the size of the funds being raised,
Yep.
okay. I would say that all of these funds are, you know, of a certain size and of a certain scale, right? So Vista is the biggest fund. They're raising 20 billion. Again, this is large, technology-driven. They're typically oversubscribed, and they really have a good stronghold on the private equity space when we think about technology. So they've grown significantly bigger. When we think about the private equity market, you know, Vista is absolutely a great manager to be with. You know, their performance is really, really strong. But, you know, this is a pretty large fund. And at the last meeting, there were questions around, okay, are we going to be so small that we're not relevant to this manager? And that was like a discussion point. When we think about exponents, that's a first-time fund. With first-time funds, you typically look at, you know, less aggressive fundraising targets, so 300 million for them. Mesirow, they're just shy of $1 billion, so they've kept it pretty consistent. You know, not going for significant numbers, not looking to, you know, compete with the Vistas and so on. Sango, this is their fund 4. They have a hard cap of 300 million. They've consistently increased the number of, or the ceiling on the funds that they're raising. And then Adam Street, you know, a comparable with Mesirow, probably a little bit more in the, plays more in the mid-market space, and less so in the small market space, but they're a competitor with Mesirow. They're at the 1 billion mark. So again, these are pretty sizable institutional funds.
Close dates. Some of these close dates are passed.
Yeah, so they've, long story short, they've all extended their close dates.
Okay.
Yeah, so.
Yeah, we asked them about that last week
Yeah.
when we
Yeah,
saw
but
that.
they said they were thinking about it, and I
No, they
wasn't sure if they
said- I
said
followed up.
by February. Okay.
Yeah, so 2023, we've definitely seen an environment where even really good managers are still just lining up the final investors. It's taking a little bit longer.
Okay.
And yeah, every fund here has extended their close. We're looking at end of 1Q 2024. That's really the standard now across all these managers.
Because I didn't want to see anything we couldn't have. This is terrible.
Right, so this takes us to, so we've gone through the follow-up information, we've gone through the memo really quickly. Just to recap on the presentations and the search process we went through, you know, I would say that Mesirow and Sango, in terms of their rapport with the trustees, in terms of their investment thesis, in terms of hitting many of the criteria that were laid out, investment and non-investment, I would say that those two would be positioned as the leaders of the pack in terms of the search and the recommendations. Now, with Mesirow, this is a you know, this is a fund-to-fund structure, so it's a more diversified portfolio. The expectation, subject to approval of the recommendation, would be for Mesirow to take the bulk of the allocation. So let's say approximately 15 million. So we have, just to talk about, bless you, just to talk about dollar amounts really quickly. So private equity is 10% of the allocation. We would expect to deploy 20 million, approximately 20 million today. And then in the next year to 18 months, look at an additional manager that we deploy another 5 million to or so. So that's really the thought process here. So back to the two managers that kind of hit it out of the park from a note-taking, from a resonance, from an investment thesis standpoint. Mesirow, diversified fund-of-fund strategy. You know, they've held up well across different market environments. They've launched a number of funds very successfully. So in our opinion, they would represent a good core allocation, first-time allocation for us. So that would be approximately 15 million. Sango would be the second consideration. That would be approximately 5 million for the Sango allocation. So I'm going to pause and stop there. See if there are any comments or questions regarding.
Any questions?
Sure. No, I feel like you read my mind. Because before I came, I had all my notebooks there, and I reviewed them last night, and I love that. I think that putting the bulk of our resources behind a bigger company, but not one so big that they forget about us. That was one of the questions I cared about. I didn't want us to be like a drop in the ocean. And in the other company that we're saying 5 million, I think 5 million is a great way to start with them. Anybody that flies 16.5 hours to talk to me is gonna work for me. So I just that really blew me away. That somebody, I mean, I can barely get people to come from Mobile sometime to meet with me came from. So I just really think that you brought us great finalists, and of the finalists, those two really stood out to me as just being a good representative stewards of our hard-earned money from our employees. Like that's just that was great. I really agree with that. That
So
resonates with me.
Since we just jumped to like a final, can we maybe take one little step back just so we understand kind of what we're talking about?
Yeah,
So
absolutely.
there's two that are smaller sized funds,
Mhm.
right? Around the 250 to 300 million, that's Sango and Exponence. And then the three that are the larger are Adams, Mesero, and Vista. Vista is the very, very large 20 billion. The other two are right around $1 billion.
Mhm.
Okay. When you look at the sub asset class allocations and the strategy between Mesero and Adams, they're not significantly different, although it seemed in the presentations, Adams were the first out of the gate, and Mesero sat and listened to all the presentations ahead of time, and so you could feel the difference in the room because they knew, at least in my opinion, they were the last ones to go versus the first ones. So the first ones, not only did we get our rhythm, but they also, I know you said the feeling and the note taking but when you look at the actual numbers, those two companies are pretty similar, both in strategy and subclassifications and fund size and historical returns.
Correct, and that's really where there's the scientific part, which is like the numbers, and then the art part is okay, the team, client service, who's going to be servicing the account, all that stuff. So that's really when we think about manager decisions and how those manager decisions are made. This won't be the first time, it won't be the last time we run into a situation where you have two comparables, and then based off the comparables, you start looking at other factors to really peel off one versus the other. And it goes back to any manager we bring in front of you is going to be a really good manager, and it has to be a hard decision.
Right.
Ultimately, yes, it would be. It's a hard decision to, of the five, pick the two, and in kind of making that hard decision, again, taking into account the conversations, the feedback, the performance caliber of the team,
Yeah.
Commitment to client service, and so on. All
I
of
hear
those
you.
things are the differentiators.
But so when we're talking about, can we like look at the two separate, like the bigger ones and the smaller ones?
But
Can we talk about
that's
that?
your process, but I think we've all done that, and
Okay.
if we want to talk through it, that's great. But I think that's what we're all doing.
Right, but instead of just saying, here's the final solution, yay or nay, can we just talk through it maybe a little bit more step by step and look at the three and the two?
I'm fine, but but we did spend an entire meeting on this, and we had a month since the last time to look at that. So I'm not
We
disagreeing.
spent an entire meeting discussing the findings.
I'm just saying that they came and presented to us. We had
Right.
packets, and we
Yeah.
had time to digest them on our own. And so this isn't my first time sort of
I know,
looking at this.
I hear you.
So I'm saying that I don't want it to seem like we're just rushing, because this isn't a rush.
It's not a rush, that's not what I'm saying, but I think we do need to discuss the overall findings and everyone's opinion, kind of the similar to way that like a
Well,
group votes.
What I would ask is that Mesero is making, Marquez is making a recommendation. There's a reason why you're making those two recommendations to us. Can you further clarify?
Well, no, I guess my question is, do you have a different way you want to go? Because that's easier for me. Like if you're thinking this is cool, great.
So-
But if you think I don't agree with this, like roll yours out and let's go.
So I don't necessarily completely agree with that. And,
Okay, then
but I
what you
wanted to
got?
look at, right, so you look at a risk profile and you have your tried and true and your larger funds at a certain risk profile, right? They're very diversified, they're larger funds. So your three big companies are in that larger bucket, and then you have your small companies, which are two different risk profiles. So I don't think you can compare those two. I think there's two different things. So if you talk about your big three, like I wasn't comfortable with Vista mostly because of the fund size and also because of the AI unknown component. So I was okay with just scratching that, and I've heard that from, does everyone feel that's scratching that
So,
as
so
one of
you
the
disagree
potential.
with the Mesero?
No, Vista.
No,
Vista.
Vista out, but
No,
then
I'm-
Mesero and Adams, to me,
So,
were
I'm
very
just-
similar, so
I'm that,
there
and I
wasn't a
heard
clear
that, so I'm
winner.
saying, what's the winner for you, Adams or Mesero? Like, that's the part I want to make sure I understand.
And if we need further clarification, I still want to get to the point of why Marquette recommended these two. And if there's a need to clarify that, I'd ask Quaco to
If
do
we're not
that.
disagreeing, then good.
So this is where I disagree. I think when you talk about diversification, we don't have to have a percentage in the small bucket. We could diversify in the big bucket and have a percentage go to Mesero and a percentage go to Adams. There's not a requirement to have a percentage go to the
But why
small
would we
bucket.
do two things with the same profile? That doesn't make any sense.
They're
to me.
similar profile, but they're not investing in the same companies.
But they're taking the same kind of approach. And to me,
Yes.
like, it would be like getting two guys from Uptown versus a guy from Uptown and a guy from the West Bank. They're all investors, but they're representing different things. So I mean, so if we're going to pick two of them, I don't want to pick two clones.
I don't think they're clones because they're different teams, and they're both tried and true teams that have never lost money for their clients. And this is a long-term investment, and it's a riskier asset class already. So the more conservative we can be in a riskier asset class has the better long-term outcome.
And again, I understand your point. I don't agree with that as rationale.
Yeah.
But this is, I understand your point now, because that's why I was pushing. I was like, what are you
Yeah.
saying?
2021 and 22 for Adams.
They didn't have funds in those years, so anytime we show a vintage year,
Vintage year 21, 22, why Adam
They
has
didn't
missing
wa-
numbers.
they didn't launch a fund. So anytime you see a vintage year, that means the manager launched a fund that year.
They
Anytime
are
you
the
don't
one
see,
who invest the most in technology.
that's Vista.
Yes,
So
Vista.
that's these guys right here. Yes.
Can I ask a question? Can you speak to what any disadvantage would be in sort of splitting up the larger share that we would invest in either Mesero or Adams?
So both of them together in the portfolio?
Yeah, like if we were to split whatever we were proposing and go with
So-
both of them.
We won't meet the
Is
minimum.
that- is
We won't
that-
meet the minimum.
It would technically
Is that-
be, it would be more duplicative, I would say. We run the risk of being a little bit more duplicative, so they are different in terms of team and brand, but they still fish in the same or very similar ponds.
Okay.
So when we think about return streams or correlation of returns, they would be pretty similar. And then when we think about the overall fund size, both of them are hovering around the billion mark. So similar sized structures, similar sized in terms of fund-to-fund approach. Again, it would be a little bit more duplicative. It's not to say we can't do it, but back to this is private equity. This is a more inefficient area of the market. Do we want a manager that's, it's called the core satellite approach, where you have your core manager does the dependable blocking and tackling. You pretty much know what you're going to get. And then do you go with another good manager that's a diversifier to that dependable manager? So that's really where the two names came in. They were distinctly different enough from each other to say, you know what, they're really good complements. But to the question earlier around, okay, one is more established with a longer track record, one is newer in nature, with the newer fund, and whenever faced with decisions around newer funds, you typically look at, the minimum allocation. If it's an idea, theme that, you believe will pay off in the long term, and then you pair it up with a manager that's more broadly diversified. So that's typically what we look at. And again, being a little bit more duplicative in our exposure would be wasted alpha opportunity, basically. So that's really why it wasn't Adams and Mesero.
Okay.
For the record.
Can I ask a
I
quick?
feel like if you strike out with that strategy, you're a double strikeout because they're both doing the same kind of thing. Whereas if you get one that's kind of doing this thing and one that's doing something a different way, if we strike out with our tried and true, we aren't. The whole fund isn't wiped out because we don't have two companies doing the same kind of thing. Like that's what it felt like to me when you talk about it.
But that strategy is 40-year tried and true with no lost revenue ever in 40
And,
years.
but again,
That's a pretty good track record.
but his point is they're both fishing in the same pond.
I
and
hear
doing
you.
the same kind of thing.
I hear you.
So I had a follow-up to my question. So I asked if there's any disadvantage. So are there increased fees that we would be looking at? Like, are there fees that are associated with making these investments that maybe we would end up paying more if we did both? Or I'm talking about really specific disadvantages, because you're talking a lot about sort of, conceptually, obviously, yeah, it's duplicative, but like,
Right.
are there any, specific disadvantages?
I mean, the fees would be a little higher with two fund of funds versus a direct and a fund of funds. So that's one consideration. The good news is fees for fund of funds have continued to come down and be more competitive, but slightly higher fees from two fund of funds would be, the definite takeaway there versus the direct.
And so you also said when you're talking about an emerging company, that you would do the minimum allocation, which for Sengo was 1 million, but you suggest 5 million. Can you explain why there's an increase?
I thought it was 5 million. So
They said 1.
for some reason I had 5.
That wasn't on my
That's
notes
fine,
either,
right.
because I was worried that we weren't gonna qualify if we didn't send enough money.
Yeah.
And I know sometimes minimums and what have you will change, but I have 5 on.
You have
my
5
record.
on yours?
Yeah, so that's really where I'm coming with on the 5 is.
Now, the original fund was a 1 million in, but maybe that was a confusion, because this is not their first round.
No, this is their, 7th or 8th?
Yeah, that's what I'm saying. So the minimum buy-in wasn't the same from the first one to the
this
current
one.
one.
And your risk profile for funding, direct funding
So
in Africa is not a concern with global powers at war? I mean, they had a lot of statistics about how it's getting better, but we didn't have global powers at war. So now, is that really conservative?
yeah, so and I should have also mentioned Sango will invest in other funds as well. So it's not they're investing directly in Africa, but they are a fund of funds structure as well. So I should have mentioned that. The fee structure is just still going to be different. It's still going to be a little bit more competitive than the fund of funds we think about traditionally. But to the question around the geographic exposures of Sango, I would say that we don't wherever we are in the globe, we really don't know what's going to happen. Here's a really good example, right? So I remember where there's a large utility company and a peer in the industry managed their private markets group. He was out in Kenya at the time there was a terrorist attack. And he received a call from the client saying, are you going to invest in here because there was a terrorist attack? His response was, well, we still invest in Boston and New York, and there were terrorist attacks there, right? So it does become tough to predict what's going to happen globally. But I will say this statistically, Africa has the most democracies on the globe. It's seen the most peaceful transitions of power over the last decade or so. But yes, there are issues happening in Ethiopia, Somalia, and other countries. These are the countries that Sango would avoid when we think about the African continent. So you're thinking more South Africa, Nigeria, Ghana. I want to say North African economies. But yeah, geopolitical risk, even in the U.S.
Very high.
Yeah, Fitch, S&P.
And they're abiding by U.S. rules because they're U.S. registered. Right?
Yeah.
They aren't just doing their own thing over there.
But no, the question around geopolitical conflict, I think it's a very fair one. And I would say even in the U.S., like we have been downgraded here by the major rating agencies due to concerns around the political environment and things potentially kicking off because people can't act right anymore. So I had to get that personal comment out. But no, I would say that yes, it definitely is something that's of concern, but it's not. It's not something that's been realized in the fund. I think that's the best way to put it. The fund is invested in countries and in businesses that have been more stable from democratic standpoint, more defined from a property rights standpoint, and then in the types of businesses that would be stable across many different market cycles. So supermarkets, things for an emerging middle and upper class. But again, without the crystal ball, and there wouldn't be a news media if there wasn't conflict around the globe. I couldn't say with certainty that we're going to avoid everything, but it does appear that their strategy has continued to kind of avoid like those major landmines when you think about countries that have run into issues with democracy and so on.
Can we see just really quickly, sorry, can we see the diversity statistics again for
Absolutely.
Adams Street and Mercero?
Yeah, absolutely. So
Mesero?
this is the financial services industry lacks.
For sure.
Lacks diversity. So these numbers, they're pretty good when we think about private equity
Yeah.
firms.
And that the fact that that's good is just,
Yeah,
So,
but it is what it is.
yeah.
But I'm
so-
just curious, if we're looking at the two of these and we're saying they're largely the same in terms of their investments and what their returns could be, perhaps this is a metric too that is important to us.
Right, and the numbers here, I think the one consistent thing with all the firms is the increased gender diversity we've seen over the years. The racial diversity is going to be different across the different firms. So this is where I get in trouble now, like whenever I say certain things. But you'll see that certain groups have higher populations in some companies, other groups do not. And Adams Street versus Mesero, we get a sense of the diversity and the diversity breakdown there. Sango, get a sense of the diversity and the breakdown there. And then Vista there as well. So the numbers are definitely trending the right way. But yeah, there is a difference in which subgroups are part of the team.
And are both owners and like investors in their own funds? I know Adams Street, they specifically said that they talked about ownership, right?
Yes. it did.
And Mesero did as well, and I know they were investing a certain percentage in their funds, I just can't remember.
Yeah, it's pretty much industry standard. So the GP, the general partner, all of these managers are the GP. So as GPs, you'll typically have a GP. All these managers do invest in their funds, and it's a way of really just saying, hey, we're eating our own cooking, and we're going to live and die by our results as well. So that is something they all do. Yep.
Well, we're at a point, I think Marquette has, with their research team, done the analysis. They have made a recommendation to this committee. Unless there are really further any questions, I'd like to get to the point where we address a motion based on the recommendations from Marquette. And again, I ask, is there anything else, Kwaku, that you would need to say to us based on your analysis, the research team that worked on this, and the final recommendation?
No, I mean, I would say that it's supposed to be a tough decision.
Yeah, it
Again,
is.
having good managers to take a look at, it's like, I'm not a car person, it's a bad example, but if you're a car person, hopefully it's a tough decision, right, to shop between different brands. And I would say that's, the analogy I'd use here. These are all really good managers. Some we've used more than others. Some are bigger than others, but ultimately it's down to the client fit. I think this document, going back to this,
And part of that recommendation is based on a client fit, your
Yes,
assessment of that.
yes, absolutely.
Yeah.
And again, the memo here, I think does a good job of really underscoring. We looked at minimum qualifications, we looked at the experience of the team, investment philosophy, methodology. Definitely there have been some great questions around risk, and I want to emphasize again that, any type of investing, particularly over 7% or reaching 7%, you're going to have to take risk. The goal is to get compensated for the risk that we're taking. And I think as we go through the memo, the thesis of each firm is laid out pretty nicely. The returns of each firm are essentially laid out nicely for us as well. So we get a sense of the investment acumen of the various strategies. And then ultimately, the questions around fit, the questions around client service, all of that would be, factored into the final decision. So again, going back to the recommendation, I would say Mesro and Sango, Mesro being the larger allocation, Sango being the smaller satellite allocation. I think that would be, our recommendation. But again, I will pause, and it's a board trustee decision. So I'll pause and see if there's anything else from you guys.
Yeah, but based on the numbers you are presenting here, historically, Vista has outperformed any one of those other four. I mean, as far as the IRR percentage. So
Yeah,
why Vista is not in your recommendation?
So during
See,
the
at the end of
discussion,
the day, as an employee representative, we are looking at the highest and most consistent performance.
yeah, absolutely.
Other factors do count in, but at the end of the day, we're looking for the best return for our employees.
Yeah, absolutely. And I would say with Vista,
And as an employee representative, who are the beneficiary,
absolutely,
our vote counts the most.
absolutely. Well, I said absolutely.
Okay,
I'm not
well,
touching
I've
that
got maybe a different
touching that
perspective
one.
because in my
Well,
mind,
I'd like to hear his answer to that,
Yeah.
because he said, why did you leave Vista off? I'm curious
Yeah.
to hear your answer
Yeah,
to
I
this
mean,
question.
I think again, going back to all these managers are good managers on a standalone basis. We wouldn't be recommending any of these managers if we didn't think they were good. Now with Vista, I think the discussion that took place focused a lot on their investing in AI, artificial intelligence.
Technology.
Yes. And look, for some plan sponsors, that's a great thing. For others, there's the moral component of that. And when you're looking at a return stream for a portfolio, strong returns are obviously where you want to start. But then the manager you want to be with, you're going to, through a process of elimination, decide whether AI and some of these other factors for the return stream of what you want to participate in, or whether it's something you'd want to pass on.
No, my question is that your analysis are based on the risk on AI, or you have some other points because of they're heavily investing in the AI or technology, you are shying away recommending them?
So no, I'll put it this way: nothing from my end. All of the managers were brought forward because we felt they could do an exceptional job for the fund. But during the discussion and the review, and again taking into account feedback from the committee, the performance has been strong and very consistent with Vista, but it's been strong and very consistent with the other managers, even though it's lower, right? So taking into account, Vista's expertise, taking into account where they get their returns from, that was a decision that was made, Vista versus, let's say, Mesro, or Vista versus Adams Street. And in those discussions, Mesro ended up, showing better, I would say, from a diversification standpoint, from risk exposure standpoint, and so on. But they're a solid manager. I've invested a handful of clients this year in Vista, so I have no issue with Vista. But like any type of matchmaking, you want to make sure the fit is there. You want to make sure that questions that were asked during the interview resonated with the board, and all of that was factored into the decision that was made.
Again, I go back to the point. It's not a question of looking at these managers and saying one is necessarily better than the other. Marquette did an analysis of all the presenters and all the private equity managers, and you have made a recommendation to this committee. And that recommendation is based on a number of criteria and factors. And you recommended 2 firms to us. You have indicated the rationale why. And at this point, we could continue, but I'd like to get to a point where we consider a motion based on your recommendation and go from there. Any other questions?
Can we just confirm the minimum allocation for Sango?
Yeah,
That would just be my only question. Because it looks like if we were to invest based on on the recommended 5 and 15, it would be about a 2% stake in the fund for Sango and a 1.5%. Is that correct? Oh my gosh, my math. In Mesro?
I'm sorry if you could ask, because I was just about to send a question to someone,
The-
so.
So I'm just trying to understand, like, if we were to invest, like you said, the percent stake that our investment would represent in that fund structure.
Right,
And so my question would be, I just want to make sure that that is in fact the minimum is the 5 million.
yeah, I will,
Not that a 25-75 isn't bad for a main and a satellite investment structure, but I just want to make sure that that is in fact the minimum, or if we're going outside of that recommendation.
all right, I have just, so one thing we've done in situations like this is, we can put a proposal together, but say subject to the minimum being X amount, if we don't hear back in a timely fashion, but I have just reached out to confirm the 5 million. I believe it's 5 million.
Okay.
I have a question. So that allocation was a part of the RFP? The 5 million versus 1 million, that was a part of the RFP? Where did that come from?
No, so that is, so the total amount was part of the RFP. So when we issued the RFP, we said the allocation was for approximately, well, was for 10% of the portfolio. We gave the approximate dollar amount, but until we got all the responses, we couldn't put the cart before the horse and say, okay, this is how much is gonna go on each manager, because we didn't know who was gonna respond. We actually got a really healthy number of responses, and then based off that, we were able to look at core satellite exposures as opposed to just one firm or 3 firms. So that's really, how the process went.
And is that usually your 25-75% split between core and satellite? Is that generally?
Yeah, definitely. So with core satellite approaches, 25 is enough to make a contribution to the returns, but not so much that you have like specialty exposure, like you're looking for specialty exposure to lead the performance of the composite. So when we think about a core exposure, this is your more steady eddy. It's going to be right down the middle. It's going to continue to do well across different market environments, and having that at 75% sets a really nice base. And then the 25 just allows for enough room for that opportunistic or niche exposure to express itself, but not so much that you're taking on more risk or concentration risk that you like. So 75-25 is very standard. 80-20 is the other mix we'll see, but 75-25 is definitely what we see.
And
Chair,
just to respond to that, this recommendation also goes to the Board of Trustees.
yeah.
So if we need some time to deal with that minimum fee,
Yeah.
we have time. to
We
do
have
that.
time.
But I really want to move forward.
So for me, in the event of a tie, I defer to the expert. And if the expert who does this for a living says, I've looked at all of this and this looks reasonable to me, and I don't have anything in my direct experience to refute that, I move that we move with 15 million in Mesro and 5 million in the Sango Fund, as recommended by our manager.
Second.
We have a second. We have a motion and a second.
I just have a question, sir, if you don't mind. Sure. Look, at the end of the day, if I'm an employee, I'm looking at the best return and the best performance. Why not we have Vista in the equation? I know it's the only detriment to us from Vista's standpoint is drop in the bucket because of their large portfolio. 220 billion, right?
Yeah, it'll be 20 billion for this
So would
fundraiser.
they be able to give us the same attention as a, big capital investor?
So
That's the only detriment I see.
Well, you also have to look at the different risk profile. You're not diversified at all. You're only in technology. And when we talk about the speed of light of a changing technology, AI is as fast as it goes. And this is a long-term investment. This is not a short-term investment. So we cannot determine what's gonna happen when something's the speed of light, versus something that has a 50-year history.
And
you know?
AI is still a questionable situation. across the
Yeah,
board.
I would just say as a pensioner also, if we can make our actuarial requirements with a fund that's a little bit safer, I'm more comfortable with that than I am with going, shooting for the stars,
And
and
missing.
trying to get really high returns and then it not working out for some reason, and then we're in a pickle.
All right, we have a motion on the floor and we have a second.
Is this a roll call vote, or do we have to do it as
Any
voice?
discussion? Any
Any
discussion?
further discussion?
Other
No,
comments?
we have roll call?
Roll call vote.
Okay.
Yes,
Roll call vote.
roll
Okay.
call vote.
Call for the question. All in favor?
Sure. I'm looking for my,
You gave it to Danielle, no?
okay, yeah, I gave my attendance sheet. Let me have that. Thank you.
We can't
We gotta turn it in.
We're going to 5 and 15.
Yeah.
Go ahead.
Yeah.
Vote,
Yeah.
yes.
Um,
Director Pacho,
Yes.
Director Shoulders,
Yes.
Director Andrew,
Yes.
Markowitz is absent. Ms. Shine,
Yes.
Ms. Josie,
John Z, yes.
Johnson, I'm sorry.
I was like, who's Joseph?
Mr. Bagbo.
Yes, sir.
Yes. We have 6 yeses. No no's.
And I
So-
will
The motion carries.
Motion carries.
Thank you.
And I will say this, appreciate all the questions, the debate, the discussion, because
Oh, this is great.
as fiduciaries, that's exactly
How it should
what we need. So these decisions have been made after a lot of deliberation, a lot of conversation, and ultimately, again, these documents should serve as a really good reference point for you when we think about institutional managers positioned to do really well for their clients. We've just picked 2 of them in our opinion. So
There is no lock-in for 7 years or 8 years.
definitely a lock-in because it's private equity.
Okay.
So we are locked in.
Like for sure, for sure.
Yeah, so we're looking at 8 to 10 years. The other thing we want to avoid are, what we call the zombie funds, which they never die, right?
As
Sorry, Mr.
always
Chair.
have a bailout.
Mr. Chair, as in the interest of time, we can have these discussions offline.
I agree. Coco,
Yes.
the Board of Trustees will meet on December 20th. So any information relative to the question that arose with regard to fees, we need to have it as soon as possible.
So I will reach out to the managers. I've already reached out to Sango to confirm the minimum. And then I will reach out to the managers regarding fees as well. So that way, if there are specific estimates or numbers you want to provide at the recommendation, we can do that.
Okay. I just wanted you to be aware of the time factor.
Absolutely.
Okay. There are 2 information items for the committee to review in your packet. Any public comment?
None.
All right. In that case, I would like to entertain a motion for adjournment. Again, Quaco and Marquette Associates, thank you so much for your diligence, for your commitment to this task, and for presenting us with the best analysis and recommendation that a consulting can give.
Absolutely.
So we thank you.
And there's more to come. So definitely more discussions where it's going to be difficult
Motion to
to
adjourn.
figure out who, because we've got real estate coming, infrastructure coming, as well as fixed income and so on. So it's always business, never personal, and as long as it's always good managers we're putting forward, we can feel, even if there's a slight difference of opinion. I think the uniting factor is many different sets of eyes from the consultant have looked at the manager, bless you. And at the end of the day, we are very comfortable with the managers that we've brought in front of you, and we want to customize the portfolio as best as possible.
Okay.
So I'll leave you with that note.
Thank you. Motion to adjourn?
Aye.
Second? All in favor?
Aye.
Motion carries. Thank you so much.
Don't forget your lemons on the way out. I'm not taking them home.